Good afternoon, everyone. Welcome to our program entitled How to Safeguard Your Nonprofit Against Fraud and Embezzlement, Best Practices, Common Pitfalls, and Practical Strategies. My name is Jeff Tenenbaum, Chair of the Nonprofit Organizations Practice here at the Venable Law Firm, and welcome to our first program of 2014. As many of you know, and actually there was a lot of new faces today, but as many of you do know, for close to 3 years now, Venable's been putting on a monthly program in person here in our D.C. office and via webinar for those in D.C. and around the country that can't join us in person on various nonprofit legal topics. We've been doing them for quite a while now. It's nice to see that I think this may be our biggest crowd ever. The room here in D.C. is completely packed. I don't think we could fit another person in here. Altogether, we have about 350 people registered for the program, so we're very gratified to see such a great turnout for today's program, which is going to be a very good one. We have a lot of information to pack into a relatively short time, so I'm going to keep my comments brief. A few things. First off, let me give you a preview of a couple of our upcoming programs. We have some really good ones coming up. Next month on February 19th, our program will be entitled Implementing a Bring Your Own Device Policy, What Your Nonprofit Needs to Know. And then on March 20th, our program will be entitled, The OMB Super Circular, What the New Rules Mean for Nonprofit Recipients of Federal Awards. Both are going to be terrific programs. Both are very timely, hot topics, and I hope you can join us for both of those programs. In terms of some logistical matters, for those of you in the room, you have a printed booklet that has a copy of all the PowerPoint slides for today's presentation, along with bios for our speakers. And finally, some ancillary articles by some of our speakers on unrelated topics. For those of you on the webinar, you were emailed a copy of the PowerPoint slides, and tomorrow all of you will get an email that contains a link to all of the materials, the PowerPoint slides, the articles, the bios, as well as a link to the recording of the program from today. We record all of these webinars and post them on our website, so feel free to share that email tomorrow with colleagues or others who you think may benefit from the program. And all of our prior webinars are hosted on our website. The link is on the last page of today's PowerPoint presentation, but if you go to venable.com/nonprofit/recordings, you can find all of our recorded webinars, and I encourage you to take a look and listen and watch those that may be of interest to you. In terms of questions, in light of both the large number of people we have today in the room and on the phone, and in addition to the number of speakers and the amount of material we have to cover, we're not going to be able to take questions throughout as we often like to do, but do save your questions for the end, and we'll have some time at the end for questions. Those of you in the room can ask your questions obviously live. Two folks in the back will be walking around with handheld microphones. Please wait for the microphone before you ask your question so everyone on the webinar can hear the question. And those of you in the webinar, pose your questions to me via the chat feature on the webcast software. I'll have the laptop at the front of the room, and we'll pose questions to our speakers at the appropriate times. Now, getting to the best part, our speakers for today. We have three terrific panelists for today's program. To my immediate right is Joe Stevens. Joe is an investigative reporter for the Washington Post. He's been there since 1999. He's a three-time winner of the George Polk Award, and with colleagues on 3 occasions has been a jury-nominated finalist for the Pulitzer Prize. Joe is here today, well, in part because he's a great guy and a great speaker, but most importantly, Joe is the lead investigative reporter on the now very notable Washington Post series that ran late last year, really shedding the light on a lot of fraud and embezzlement in nonprofit organizations that had not been previously publicly disclosed. Joe and his colleagues did a terrific job in the investigative reporting, which led to a series of articles. And Joe's going to be touching on the process that they went through, some of their basic findings and observations and insights for you here today. To Joe's right is Nidhi Rao. Nidhi is consulting director at the BDO CPA firm. Nidhi specializes in forensic accounting, fraud investigations, and internal control reviews. She's a real expert in this area from the accounting side, and is going to have some terrific insights for you here today. And finally, to Nidhi's right is Widge Devaney. Widge is my partner and colleague at Venable. Widge is co-chair of Venable's Foreign Corrupt Practices Act and Anti-Corruption Group. He's a former federal prosecutor. Widge and I have worked closely together for many years in connection with fraud and embezzlement investigations for nonprofit organizations. He's a real expert in this area, not only with respect to the prevention and detection of fraud and embezzlement generally, but as it applies in the nonprofit setting. And I know you're going to enjoy hearing from Widge today. So without further ado, I'm going to turn it over to Joe to get us started. Joe?
Thanks, Jeff. Really appreciate it. And appreciate everyone turning out today. Is that better? As Jeff said, I'm a reporter at the Washington Post. I've been doing in-depth projects there for coming up on 15 years. And originally thought Jeff maybe had made a mistake inviting me here because I'm not an attorney or an accountant, and I don't work in a nonprofit field. But over the years, I have occasionally come back around in a circle and written about the intersection of law and accounting and the nonprofit sector. And I've learned a little bit, but I'm probably the least expert person in this room, would be my guess. But Jeff wanted me to talk about my latest project, which has come to be known by the name of Missing Millions, which is not that catchy, but a little catchy. And many people contributed to that work, most notably my colleague Mary Pat Flaherty, another reporter at the Post. But we had a lot of data people, a lot of graphics people, a big team. So I was just one of many on this. And if I happen to misspeak on anything, I'd refer you to the stories themselves. I think there are copies of one or two in your packet, and there, more importantly, are links to our whole package, which has a lot of interactive things, a lot of kind of cool things, frankly, that you can do and research for yourself. And I'd encourage you to do your own investigation using those tools. And it's got a lot of people looking in around the country and around the world, actually, on that whole package of things we have on our website. And I'm just going to give a quick overview, but the real meat is there. If I misspeak, what's in the stories is completely accurate and in context and has the full view. This project had its genesis more than a year ago when I was reviewing an IRS Form 990 tax return, which probably people in this room are familiar with. Now it's more of a public disclosure form than a tax return filed by most nonprofits in the country. And I sometimes read these for fun because I'm an odd guy. And I noticed a box had been checked that I'd never noticed before, just going through for a large local group in Washington. And it was in Part 6, Line 5, and it said, quote, "Did the organization become aware during the year of a significant diversion of the organization's assets?" I'd never noticed that before. It looked intriguing, and I didn't know what a significant diversion really was. I was perplexed, but I looked in Nexus and I did some Googling, trying to find out what the question actually meant, what it was asking about. And I found no evidence that that question had ever been mentioned in a news article, in a newspaper, in a general circulation publication of any sort. It's like, that's intriguing to me. Some people would think it must be so boring, no one cares, move on. But it got me interested. So one of the places I went was the IRS instruction booklet for filling out the Form 990. And this is what it said there, quote, on line 5, answer yes if the organization became aware during the organization's tax year of a significant diversion of its assets. Explain the nature of the diversion, amounts or property involved, corrective actions taken, and pertinent circumstances. And that's all supposed to go on Schedule O, which is generally towards the end of the 990. If you looked around further, you could find that the IRS instructions defined a diversion as, quote, what the court said is that a diversion of assets includes any unauthorized conversion or use of the organization's assets other than for the organization's authorized purposes, including embezzlement or theft. Now, still not that exciting, but the embezzlement and theft part got me intrigued. So that sent me off on a journey of discovery that consumed much of my last year, along with some of my colleagues, including Mary Pat Flaherty. And to make a long story short, after finding some groups who had checked this box and had some interesting circumstances, we enlisted the help of GuideStar to help us do a more thorough search. And we put together a database of more than 1,000 nonprofit organizations that had checked that box since 2008 when it first started being phased in. Now, those hundreds of organizations that ended up in our final database are just a tiny, tiny portion of the groups who have faced thefts and embezzlements or other diversions for a number of reasons, some technical, some not so technical. It was phased in. Not all groups have to answer this question. But putting together this list allowed us to draw some conclusions out of that group of over 1,000 groups. And we're very careful about extrapolating to the whole universe of nonprofits. But some of the trends we saw is, one, most of those diversions were indeed attributed to theft, embezzlement, and investment fraud. Many of the losses were quite large. Just 10 of the largest losses we found, and we clearly didn't find all the losses, but 10 of the largest ones we found totaled more than $500 million. So that would suggest that the total amount being lost by nonprofits to diversions was many, many times that $500 million amount. We didn't try to estimate the whole amount because we thought that would be sort of more disinformation than information, but a lot of money. There were also a lot of small diversions in this group, groups that had lost 10,000 here, 10,000 there. In fact, some of those appeared to be the most damaging because if you're a group which takes in $50,000 a year and someone stole $40,000 from you, that can shut down your whole organization or stop your programs for that year. So the smaller ones were no less damaging than the big ones. Some of the thefts and embezzlements in these forms had come to public attention before our articles, but a lot of them had not. They'd never been in a news story. Some, no one outside of the boardroom had heard of them. In fact, when I got to the point where I was picking up the phone and calling nonprofit executives, there were a number of them where I'd get the executive director or the chairman on the phone and they'd say, "You saw what? And it was where?" They did not know that their group had actually disclosed a diversion in their 990. Sometimes these were the people who would actually sign the forms. So made for some awkward conversations sometimes. One of the most striking findings is that the nonprofits routinely omitted details from their Form 990s, leaving donors, members, and the general public just to guess what happened in diversions, even though they had checked that box saying they had had one. And this took place even though IRS instructions specifically directed nonprofit groups to explain the circumstances of the incidents. As I said earlier, the instructions say, quote, "Explain the nature of the diversion, amounts or property involved, corrective actions taken, and pertinent circumstances." But a lot of groups didn't even file anything on the Schedule O. In fact, our analysis found that more than half of the organizations on our list did not disclose the total amount lost. And to step back a little, the IRS requires the threshold for disclosing. You don't have, if someone takes a package of pins from the supply closet, you don't have to disclose it. But IRS requires disclosures of any diversions over $250,000 or identified as having exceeded 5% of organization's gross assets or total assets, or excuse me, gross receipts or total assets. Now, as I said, you can check this out for yourself. You can go to our database. I think there's a link in your packet. If not, let me know after this and I can send you a link. And we're kind of proud of this. It's the first public searchable database of nonprofits that have disclosed diversions. And it's got a lot of interest from the general public, as well as it's caused some ripples that we didn't even expect. It's been used in some intriguing ways that we never really saw. So the stories we publish went into some specific details pulled from that database and go into some great detail on incidents at some individual nonprofits. I'm not going to go into a lot of that now. But as a quick overview, just to give you a sense, for groups just since we're in Washington, in the Washington area, one was Youth Service America, YSA, which is based a few blocks from here. It reported there'd been a diversion in 2009 of about $2 million that, in its words, had been, quote unquote, misappropriated by a former employee. Despite this having occurred in 2009, when I ran across this in what I suppose would be probably early 2013, the person would no longer worked for the organization, but nothing had happened. After we placed a few phone calls, this guy was charged in federal court in June, and he was sentenced to 4 years in prison for theft. Another local charity, the Alliance for Excellent Education, disclosed that Bernie Madoff's Ponzi scheme, which you probably have heard of, wiped $7 million from its balance sheets. AARP, the national charity that advocates for older Americans, had suffered $230,000 in losses in 2 different instances attributed to embezzlement and billing irregularities. No one's been charged in those cases. The Maryland Legal Aid Bureau disclosed that a former finance director and an accomplice had made off with roughly $2.5 million. Now, in our stories, we reported extensively on one fraud. We used as sort of a case example involving a group known as the American Legacy Foundation. And this is a group established by state attorney generals that fights tobacco use. And the legacy says that it lost an estimated $3.4 million. And that loss was linked to purchases of IT equipment, kind of a boring area, from a business that they described as a computer supply firm. Now, other people we talked to described this company as a barbershop. Legacy also contends the loss was linked to a senior executive at Legacy who has since left. That executive we found during our reporting now runs a video game emporium in Lagos, Nigeria. One of the striking aspects of this case is that an internal whistleblower raised questions about these purchases initially almost 3 years before Legacy initiated a formal investigation. Also striking is that the foundation did not disclose the size of the loss on its Form 990. And the foundation, as I said, which is founded and is still governed in large part by state attorney general, takes a position that has no responsibility to disclose that amount to the IRS or to the public on its Form 990. After some discussions, they did tell us the amount of the loss that they believe took place in any case. On the form, they just described it as in excess of $250,000. And that loss, no one has been sued civilly and no one has been charged criminally for the alleged fraud. Now, if we pull back the lens and look nationally, the dollar figures go up considerably. In some cases, some of the money has been recovered through insurance recovery, through criminal cases and things like that. In other cases, the amount of the final total loss is still quite large. We found that investment fraud was blamed for some of the largest losses we found. The biggest was over $100 million, and that was to Yeshiva University, which says it lost that amount from the university and its affiliates to Bernie Madoff's Ponzi scheme. And Madoff, as you may recall, was on the board at Yeshiva for, I believe, more than a decade. Madoff's scheme also was blamed for nearly $40 million taken from the upstate New York Engineers Health Fund and $26 million from New York University. But we found that beyond investment schemes and Ponzi schemes, a lot of money was also lost in other kinds of more routine crimes. The Global Fund to Fight AIDS reported it had found evidence of misuse or unsubstantiated spending of $43 million in grant funds. The Conference on Jewish Claims Against Germany, which benefits Holocaust survivors, reported it had been bilked out of $60 million meant for Holocaust survivors, and an elaborate decade-long conspiracy by a group of swindlers, including some insiders, who created thousands of fake identities for supposed Holocaust survivers. Vassar Brothers Medical Center in Poughkeepsie said it lost $8.6 million through, quote, the theft of certain medical devices, end quote. They've declined to tell us what the heck that means. So you can write your own backstory on that. In one case, there's a group called the Woodcock Foundation in Kentucky, 140-year-old nonprofit, helps out needy students by giving them scholarships. And it said an apparent fraud had taken more than $1 million from it and left it with a grand total of assets of $8. So that's a sad case. In addition to reviewing just the financial records, we also talked to hundreds of nonprofit executives at hundreds of nonprofits and got a huge range of responses. Some said, we're glad to talk about it. It's a cautionary tale to help other people to know that they can be victimized and they need to be careful. Some wanted to say nothing to us at all. But here's some broad themes that occurred again and again. A number of the people found responsible in these cases were insiders, longtime executives and employees. I was told time and again that the person believed responsible was among one of the most well-liked and highly trusted person in their organization, been there forever and loved by everyone, which can be a little frightening to think about. A number of them were CFOs, executive directors. The thefts often started quite small, and then when they weren't detected, built over years. Someone would feel apparently empowered. No one's looking. And they just grew and grew, and some of the biggest losses were ones which took place over a decade. And you see this arc of the thefts, diversions getting bigger over time. The people responsible often were described as workaholics who rarely took time off. And the diversions often were discovered only after that person retired, moved on to another job, maybe became ill or took a vacation. It was sort of like the idea that the house of cards tumbled down after they took their thumb out of the dike. And my co-panelists maybe will speak about this, the idea that you have to, once you start a certain form of theft scheme, you have to keep a watch on it. You know, it's sort of like an addiction. You can't just walk away from it. You're sort of trapped by it. Many of these organizations got clean audits year after year. And when I talk to organizations, they say, well, what can we do with that? Our audit said everything was working correctly. So a clean audit in and of itself is not reason for letting down your guard. And the losses often only came to light after a whistleblower came forward and someone internally said something doesn't look right. So the bottom line here, I guess, if there is one, is to nonprofit organizations, beware, watch out. You can't assume your funds are safe, and you can't assume you're immune because you've got a great organization and everyone is dedicated to your cause. That alone isn't going to protect you. Also, broadly, I'd say a takeaway message from this is that transparency is not just something the IRS requires, which it does. It's also what donors and the public say they expect from a community institution. An institution that is not transparent about financial risks, about financial problems, risks, of course, that the information will indeed become public one day. And then that organization is in a position of explaining to donors and volunteers and stakeholders why it was not transparent to begin with. Since our articles, briefly to wrap up, there's been a lot of reaction. A number of members of Congress have expressed concern. Senator Tom Coburn, who's the ranking member of the Homeland Security Committee, has asked the GAO to investigate our findings. Senator Grassley, who's a ranking member of the Judiciary Committee, he's opened a couple investigations into possible lapses in IRS oversight and into the previously unreported $3.4 million embezzlement at the American Legacy Foundation. Charity regulators in at least 7 states and in the District of Columbia have used the Post database to open their own investigations. They went in, they saw groups in their areas and said, we need to find out what went on at these groups and if they properly disclosed it. We never foresaw that use of our database. And many news organizations in the U.S. have looked in the database, found local groups who were in there, and have done their own stories about theft and fraud and diversions in their communities. And in December, the new commissioner of the IRS, incoming, cited our articles in saying he plans to conduct his own investigation into diversions and related issues. So it remains to be seen where those various inquiries take us. Once again, I'd refer you to our articles for more details, and I'm sure my co-panelists will give lots of tips on how to keep your organization from being on a list like this in the future. And I'll give a plug. I see a couple familiar faces in the room today, people who have helped me out on these stories and some other ones in the past. I won't name them. But if you have ideas of things we should be writing about in the public, either in this area or anything else to do with nonprofit governance and related issues, please shoot me an email, grab me after this, and let me know. And thanks for listening.
Thank you, Joe. That was terrific, and great setting of the stage for Widge and Nitty. Widge, why don't you get us started?
Thanks, Jeff, and thanks, Joe. And Joe, does the Post plan to keep that database updated?
I would love to do that. If we could find a sponsor who would pay for updating it, that'd be great. Any foundation executives out there? I would love to do it, but my expectation is probably not at this point because it took a lot of resources to do that.
Well, Jeff and I have been putting on similar programs to this for a number of years. And as we go back and redo the PowerPoint or redo the articles, we're always looking for instances of fraud and embezzlement at nonprofits and to update it and to keep this current. And it's never been so easy, so thank you. And you'll see as we go through, a lot of our recent examples are ones that Joe had mentioned, including the first one is the American Legacy Foundation. And Joe told us a lot about this already, but thanks. But one of the things I just want to add to this, because it plays into a lot of themes, also some of the themes that Joe touched upon, but turning to controls is that you see here is the reason that the IT specialist or the executive that he referred to was able to get away with this was a lack of controls in terms of authority to spend the money. Somebody else, segregation of duties, checking on the money coming in, and then in terms of simple things like fixed asset inventories. Also, you see that's a great example of a poor response, that by the time law enforcement got involved, there wasn't a lot that could be done because the events had taken place so long ago. Similarly, Joe mentioned the Vassar Brothers Medical Center. And, a massive loss that, as Nitty will talk about, goes to simply if they had done a fixed asset inventory, would have been very difficult to pull off. Project Genesis. Here, this is a Connecticut-based nonprofit that serves people with disabilities. And here the CFO managed to embezzle about $350,000 from the organization over a 3-year period. Here, it's a little bit of a different scheme. The CFO kept terminated employees on the payroll and then transferred their salaries into his personal bank account. And I use these these are really tales, both cautionary tales, but more importantly, they're case studies. As we come back and we talk about the controls and why this seems to befall nonprofits, the role of the board and what you all can do to prevent this, you'll see how the facts of these cases and the ones that Joe mentioned really pull it all together. Here, the New York chapter of the American Red Cross. Again, a former director, a longtime employee here, embezzled about $275,000 over a 4-year period. And again, this is a situation where segregation of duties would have prevented the fraud, in that she just simply took out an ATM card in her name linked to the Red Cross's bank account and took out a couple $100 many times a week. The Howe Foundation, a Tulsa, Oklahoma nonprofit that does alcohol and drug treatment. Here, the former executive director, and again, a theme that Joe mentioned, office the highest ranking employees, the longest serving employees, very trusted employees, and that's something that Jeff and I have seen over the years as well. Here's an example of that. The former executive director wrote himself over 200 checks for more than $1.35 million, and that wasn't all. He also literally stuck his hand in the kitty of the thrift store they operated. He would just reach into the cash box, and he stole about another $200,000 that way. And on the larger scale, again, as from Joe's article and what he had mentioned, is the Global Fund, which had $43 million in misappropriated grant money. So as we take a look at these case studies and how this comes about, there's three things we want to look at, and that's motivation, rationalization, and opportunity. And motivation is what you see for people's motivation to do this quite often is it's economic factors. They're in financial distress, whether because of the recent recession, or there's an alcohol problem, there's a drug problem, there's some other kind of stress on the employee. The rationalization aspect of it, often it starts out as, well, I'm just going to borrow this money. And this is something that Joe touched upon as well. And that's not just with nonprofits. I mean, back when I was a federal prosecutor and you'd look at all manner of fraud, it often began with there was a financial distress and the person said, well, I just need this little bit to get it over the hump. I'm going to pay the organization. I'm going to pay my company back. And that just didn't happen. And you take a little bit once and a little bit again, you can't pay it back, and it snowballs. And several years later, when it comes to light, it's often several $100,000 or millions more. Another rationalization, and this is unfair treatment or a belief that they're being treated unfairly within a company or within an organization. And one that we see more often than not with nonprofits is you hear people say, well, if I were the CFO at a for-profit company, I would be making X, and this isn't fair. Opportunity, and that's really what we're going to be talking about today because that's where the most prevention can come in. In order for a person to commit a fraud or an embezzlement, there has to be the opportunity to do so. And that's really where the organizations can prevent this. A little bit on the rationalization side by taking away some of the rationalization or motivation, but mostly the prevention comes in with respect to opportunity. We talked a bit about why nonprofits seem to be more susceptible to it. And I think, over the years, what we have seen is management and the board members are often more trusting. Many, if not most nonprofits, have a charitable goal, an eleemosynary mission. And so management and the board tend to feel that the people who want to work there also want to be there to do good. And so we're just going to trust them. So whereas in a private company or especially at a public company, you would find all sorts of controls in place, all sorts of checks, background checks before people are hired. Often that's overlooked in nonprofits because of that reason. Similarly, we've found over the years that there are often less stringent financial controls in nonprofits. And we've also found, and this is something that Joe touched upon as well, is there's a belief, we hear it time and time again. I'm really surprised that there was a fraud here. We conducted an audit. And while audits are good, and we certainly recommend that everybody do an audit, audits are, and Nidhi can help me out with this, audits are to test that your financial statement is reasonably accurate. They're not designed to detect fraud.
Exactly. I mean, auditors do consider the risk of fraud when they're performing an audit of the financial statements, but they're limited to considering what is a material misstatement for your financial statement. They're not, making sure the audits are not designed to detect every sort of diversion. So, I mean, I think, to Rich's point, I mean, there is, when a fraud happens, when an issue comes up, there's two questions that always get asked, right, by the public. Where were the auditors and where was the board? That's like the first two questions. So it's, sometimes maybe not the right perception of the public, but it is the thing. The one thing I wanted to add to your comment, Wedge, on why are nonprofits frequently victims is there's a perception that budget to actual would catch anything because money is watched so closely. We don't have segregation of duties, but you know what? We monitor budget to actual variances, and anything odd is gonna jump out. Joe mentioned, some of these schemes went on for 10 and 20 years. Well, those numbers get baked into the budget, and all of a sudden, those variances are not sound. So it's true. Budget to actual does catch some of those things. I'm not saying to stop doing budget to actual, but it's not one of those things that's going to address your fraud risks if you don't have segregation of duties.
If I could stick in too. There were a number of groups found out in our sample large amounts of money was being stolen because someone left. And all of a sudden, it's like, we've got way too much money in the budget. And they'd been spending $50,000 a year on toner for the copiers. Yeah. And everyone thought, toner's expensive. And the guy buys the toner, retires, it's like, oh, it's not that expensive. Yeah.
So let's turn for a sec and start to talk about how to prevent fraud and embezzlement. And one of the most important things is to set a positive tone at the top for the organization. And this comes from senior management and the board. And that is just critical, including in any government investigation I've been in. The prosecutors will always sit across from me at some point and say, what was the tone at the top? How did you find that? And that's because if they see senior management that, well, I'm going to treat myself to a lavish dinner and take a car home every night because I can, that sets a tone within the organization. You know what? Let me get mine. Let me take a little bit off the bottom here. Very, very important that management set the proper tone there, and also set the proper tone with respect to controls are important. We all follow the controls. We all follow the policies and the procedures. And one thing I love to see, and we're going to talk about training, and I always recommend it, is that the CEO of the organization send out the email reminder on the training, and that he or she is in the front row at that training after saying, you know what, I'll see you all there. Very, very important to set that tone from the top. The other thing is to have an effective compliance program. Now, not all compliance programs are the same. I mean, some people, when they hear compliance program, they immediately get scared because what they imagine is a large public company that has a 15-volume program with all sorts of flow charts and things like that. And that's just not necessary. Every program needs to be tailored for the size of an organization and also for the mission of the organization. And that's all the government expects from you. But they do expect an effective compliance program, and those have certain components. One of those is you have to have a written policy. Again, it doesn't have to be volumes. It can actually be fairly short. But it's got to be a policy tailored to your mission and the particular risks in your organization. You need to figure out what those risks are and what policies you need in order to address those particular risks. Most importantly, and this goes back to tone at the top, it's got to be owned by senior management. That means somebody in the front office and also by a board member who is ultimately responsible. Certain functions can be delegated, but basically the buck has to stop with a senior manager who ultimately is responsible to a member of the board who owns that function. I mentioned before training. That's the most important aspect of a compliance policy. Many organizations, for-profit, non-profit, public, and private, have terrific compliance programs that sit in a drawer. And that's something the regulators hate to see. That's worse than not having one at all, is one that is just gathering dust. And one of the best ways to show that your compliance program is actually vibrant and that the organization takes it seriously is to conduct regular training, not just on the program itself, but you can do other sort of offshoots, other areas of risk that come up within the organization. The compliance program has to be regularly audited or monitored to make sure it's working. One, do people understand that they've been trained? Do they remember that they've been trained and certain aspects of the training so that you know that it's sinking in? Additionally, it should be monitored to see if it's effective in actually ferreting out incidents where the policy is not being adhered to. Is that happening? If you've gone 3 years without finding a violation of your policy, something is probably wrong with your auditing and monitoring. And that's not to say that violation of the policy needs to be a fraud or an embezzlement or something like that, but it's going to happen, and you need to monitor it in order to check that out. You also need to, if you do find violations of the policy, you need to address it. As my accounting friends would say, you need to mitigate that risk. But in other words, if you find something broken, you got to fix it. Very, very important. You also need a meaningful way to report. People should feel comfortable and encouraged to report to their superiors, to report to the general counsel's office, to report to somebody else in management. But also critically, if they're not comfortable doing that, there has to be a hotline. And those can be very, very inexpensive, in which people can anonymously report what they feel is a violation of the policy or anything else that would be of a concern.
Rich, I just wanted to add a couple of things. The compliance programs we talked about, that they should have a code of ethics. And Rich talked about it not being in your drawer and collecting dust. The worst thing is, this person when they were hired 10 years ago, they signed our code of conduct, they signed our ethics policy, they never heard about it again. That's not a living, breathing document. So it's what steps is the organization doing to make that a living, breathing document and make it a value for the organization. I think the other, about the hotline, it's very important that the organization also puts in some sort of procedures in place that tells them what to do when a complaint is brought in. So like if an issue is brought in, like I was involved in an investigation where somebody reported an issue about a CEO, right? And they reported it actually to their HR because they didn't have a hotline in place. Well, what did the HR person do? They went directly to the CEO. Well, not really an effective process. So you have to, we'll talk about investigative steps a little bit later, but I'm talking about really just understanding the triage. Who does that complaint get to once you've gotten a complaint? Do they know that I need to bring it up to the board, whether I need to bring it up to the senior management? Who do I talk about this issue to?
Yeah, I've seen anecdotally in doing multiple investigations that have come off of anonymous hotline complaints. What people most want to see is that it's being taken seriously. And the nice thing about those hotlines is there's two-way communication. It's all anonymous, but you can communicate back through to the whistleblower. And they're usually very satisfied and mollified when they hear, as Nidhi pointed out, that the company has certain steps, that the organization is going through those steps. And that usually goes a long way. The other thing a compliance has to have is meaningful discipline, that if you violate the policy, something happens to people. If there's not meaningful discipline, people know that. They know it very quickly in the organization. And that should include, in appropriate cases, reporting to law enforcement or regulators. So obviously, a compliance policy helps to prevent embezzlement against the organization. But I also want to mention one more aspect of a compliance policy that's just critical, and that is it's how in the United States, under our legal system, any organization, nonprofit, for-profit, defends itself against regulators and law enforcement. There's strict respondeat superior liability in the United States, which is a $5 legal word, meaning an organization is responsible for the acts of its employees. Period. Nonstop. So the way an organization defends itself when it has a rogue employee is to say, look, we've done everything reasonably possible in order to prevent these type of things from happening within our organization. And the first place you point to is your compliance program. And you point to how it's a living, breathing compliance program taken very seriously by the organization. And that's how the organization escapes liability, both either regulatory, criminal, for the actions of an employee. So the other thing I wanted to touch upon that's also critical is the role of the board, especially in smaller nonprofits. You can see that board members frequently, it's a social position. They're put on the board because the organization hopes to raise a lot of money from them. Other times they're friends or former associates of some of the executives in the organization. That can be a real problem for the organization because the board has a very, very serious and important role. The board needs to ensure that all financial decisions are made soundly and legally. The individual directors need to ensure that any financial decisions, any decisions of the organization are in the organization's best interest and not also in the best interest of a board member or a member of management. And they also have to ensure, this is particularly important in a nonprofit, that the board's assets and efforts are being directed at its mission. Many board members think, well, the business judgment rule just protects me no matter what. And that's not quite the case, because the business judgment rule requires you to put the effort into the role in terms of whether the organization is doing the right thing, whether it's using its assets effectively that a normal and prudent person would do under the circumstances. So a board of directors that essentially just comes in and doesn't do anything, doesn't read the financials, doesn't question management, isn't doing its job, and those individual directors can be liable. There was a case in New York of a nonprofit dance company, essentially, and the executive director there managed to appoint a lot of his friends and associates to the board. The dance company's main asset was this beautiful mansion in the city. And he ultimately got his real estate license, sold the mansion, took a big commission, and there was nothing left of the nonprofit. The board was actually held liable by the Attorney General of the state of New York for the director's actions, for not having appropriately supervised him, not having appropriately looked into the transaction, and assuring that it was in the best interest of the organization. So one of the things we recommend is it's very useful on a board to have at least one member that has, relevant financial experience, whether a CPA or somebody who, understands how to read a balance sheet and a general ledger. And at least some board members should be experts in either the law, nonprofits, or particular expertise with respect to the mission of the organization. So with that, those are some of the higher things. Let me throw it over to Nidhi with some of the more specifics that you all can do. And I yield the clicker.
Thanks, Rich. So to talk about, I think, which touched upon some of the high-level controls, the compliance programs, the tone at the top, what the role of the board is in reducing the risk of fraud within an organization. Now, just to get down a little bit to the granular level, because I'm an accountant and I live in the details, is talk a little bit about some of the controls and specific steps that a not-for-profit can take. So you've got, fraud risk assessments, and I think fraud risk assessments is, again, one of those things that should be tailored to the size of the organization. So, you shouldn't, when we are talking about all the different steps, if it's a small not-for-profit, you may not need to take all the different steps. You may need to take, 3 of those 5 steps, and larger organizations may need to take, all of them. So one is having an honest and comprehensive discussion about fraud. It's an ugly word. Nobody wants to talk about it. Nobody wants to really say that a fraud can happen within their organization. But really, even having that honest discussion, say, okay, how could money walk out of my organization? What are the fraud risks within my organization? And having that discussion within your management team, within your board, with your employees, is going to yield a lot of issues. You're going to become aware of a lot of issues that you didn't know existed. I would say you have to, in order to start those discussions, you want to research, historical frauds. You then want to interview the key management people, employees, board of directors, internal, external auditors. If you have a lot of satellite offices, create and send out a risk assessment survey, because what you may think is happening at the headquarters, those same type of controls may not exist at satellite offices. So send out risk assessment surveys and figure out, what type of fraud risks exist at those satellite offices. And really, once you've gathered all of that data, you may need to do a deeper dive. You prioritize your fraud risks. And if you're, let's say for your organization, one of the high fraud risks is cash disbursements, because there's really truly a lack of segregation of duties. Money could walk out. So having a detailed fraud discussion as to how fraud schemes could be conducted in cash disbursements, and really understanding what are the controls to mitigate those fraud risks. And understanding, let's say you have a control, and one of the controls is that you send a positive pay file. Does everybody know what a positive pay file is? Yeah. No. Okay. Oh, all right. Well, so positive pay file is when an organization creates sends out checks. There's a check register, right? When you do a weekly check run. Well, from a software with the bank, you're able to create a file that is sent to the bank that says, here's the check numbers, here's the amounts, and these are the checks I authorize you to pay. So when a check is presented at the bank, it's only cashed. The bank will only honor that check if it's presented in that positive pay file. Well, when you're evaluating fraud risks in a cash disbursement area, you have to see who is monitoring that positive pay file. Who is sending that positive pay file to the bank? Who is getting those exceptions? I mean, we were involved in an investigation where the CFO had complete access to the cash disbursement system. They basically, and he was able to create checks and all of that because he was an administrator. So the AP clerk would create the check register and things like that. He was responsible for creating the positive pay file. Well, he used to write checks to himself, right? And then he would insert those checks in the positive pay file and send them off to the bank. So no exception report was ever generated. And so you have to understand, evaluate how, when you're doing those fraud risk assessment discussions, how could those controls be circumvented or overridden and really put on, like, if I wanted to take money out of this organization, what would I do? Think like a crook. So segregation of duties. I mean, majority of the frauds that investigations that I've been involved in, really, the main factor is lack of segregation of duties. I think Joe alluded to that, and and Widge alluded to that as well. It's one of those things. I mean, you have to segregate the who has access to the books and records, who is reconciling the books, who has the custody of the assets, and who is authorizing those transactions. So we worked on this one investigation where the accounting manager stole about $800,000 over a period of 6 years. And the scheme was really simple. She basically stole checks stole blank checks and wrote them out to herself. She didn't even make up a company. She actually just wrote them out to herself, but she was responsible, and she wasn't responsible for doing the AP function, but she was a backup. So backup person, if the cash disbursement person went on vacation. So essentially she had access to the blank checks. She was responsible for reconciling the bank account. She was responsible for recording journal entries. So basically, when she would steal these checks, write them out to herself, she would record these checks using journal entries in the journal ledger system. And when it came time to reconcile, the bank account would reconcile. And because she was also doing budget to actual variances, she was able to move things around, so where it would fall completely under the radar, and it didn't get caught. And the only reason it got caught is because after she had, stolen so much money, she basically decided it was too much of an effort to even start coming to work on a daily basis. And the audit was happening, and the controller is like, look, I've got to get these bank recs done. The accounting manager isn't shown up for like a week now. So he starts doing the bank recs, and he's like, wait, the bank account doesn't reconcile. My journal ledger balance doesn't reconcile to my bank statement, and he started flipping, going through this, and because she hadn't kept up with her scheme, she hadn't recorded several of the checks that she had stolen, and all of a sudden, I mean, once you find like one little thing, I mean, it's just pretty easy to unravel on how this scheme unraveled.
Yeah, sometimes embezzlement can be exhausting. But there is, and it's on both ends. I mean, one of the case studies that has fallen off the PowerPoint with age, though, but is very instructive on segregation of duties, is a I can't remember the person's exact function, but they were a senior executive in the financial function, and not only were they in charge of the bank accounts, were able to write themselves a lot of checks, very similar to what Nidhi was talking about, but they were also in charge of bringing in and recording the donations to this nonprofit. So what this person did was simply balance the books by saying that these were pledges that were unfulfilled. And just very, very easy, simple scheme. The book's always balanced. Everything looked good. I just wanted to add, and it's something somebody had alluded to it earlier, but one easy control mechanism, which is a page right out of Wall Street, is require people in the finance function to take a 2-week vacation. At every bank and every trading house, every trader, they just have to take a 2-week vacation, and compliance looks at how things go in their absence. Does it go the same way? If it doesn't go the same way, then you may have a problem.
I think everybody, a lot of people in the nonprofit world have heard about Rita Crandwell case, the controller in Dixon, Illinois, who stole about $53 million over 22 years. I mean, unbelievable. And basically, the scheme started out small. I mean, started out in 1991 with she only stole $181,000 that year. And in 2008, when she was actually in 2008, she actually stole $5.8 million in that year alone. She had a whole, horse breeding business and everything else. I mean, she employed like half the town, I think, in that horse breeding business, and it was unbelievable. And the reason she got caught is because she took a vacation, and somebody found this bank account where she was writing all these checks to herself. I know one of the things that we, not-for-profit always struggle with is the segregation of duties. There are never enough people to segregate duties, and so you have to implement compensating controls. And some of those compensating controls can be very simple, things like, reviewing change reports, exception reports, rather than just saying, okay, well, 2 people have to do this type of function. You could now systems are so sophisticated, you can create exception reports and change reports and have them be monitored. We actually, BDO published a segregation of duties checklist. If you guys email me, I'll send you guys a link to that segregation of duties checklist, which talks about some compensating controls and things like that. So if you're interested in that. So double signatures. I mean, second level review and approval. It's always good to institute, purchasing thresholds. If you're purchasing over a certain dollar amount, you should get a second level signature. There are 2 cautions that I would say when instituting this type of control. One, you want to make sure that person is actually doing an effective review. So, don't set the threshold as low as like, okay, well, anything over $2,000 is going to be reviewed by the executive director. Well, they're going to review like 200 transactions. I guarantee you it's going to become a rubber stamp approval. They're not doing an effective review. The second is really, really monitor, put some sort of a monitoring control to say, okay, if your threshold is $50,000, how many purchases are coming in at $45,000? Because a lot of times what will happen is when you set that type of threshold, the purchase levels, all of a sudden you'll see an uptick on right below the threshold level, you'll see an uptick on the purchases for that amount. I think credit card statements. Really encourage people. It doesn't matter what level within your organization. They should submit expense reports. It's not a good policy to just submit your credit card statement for reimbursement. We're doing a case right now where, the individual had a corporate credit card, basically was able to put a lot of business type of transactions. And so she decided to start slipping started buying gift cards and stuff. And, she started during the holiday season and then just continued on. And basically nobody caught that transactions because of the 150 transactions on her credit card, statement, she had support for about 90% of them, or but didn't have support for 10%. So it's like when whoever was checking those transactions, they're like, oh yeah, well we have support, and they didn't really monitor. Okay, there's a $1,000 gift card transaction, or $1,000 transaction. We're not gonna, ask for support. So really, have the double signatures authorization, backup documentation. I mean, cannot stress this enough. You have to train your cash disbursement people to look at what makes up adequate supporting documentation. Is it original invoice? When to question things? When do things start to look odd? I mean, you're dealing with a vendor, and all of a sudden you get invoice number 1, 2, 3, 4, 5, 6. Well, you may want to question it. Doesn't mean it's fraudulent. It just means you want to question it. It raises a red flag. And your cash disbursement people, or whoever is processing the invoices, are your first line of defense. And if they're not trained to identify those red flags, they can bring it to anyone's attention. We were actually involved in this one investigation. It was unbelievable that the manager, she'd been doing this scheme for over 10 years, and she got so lazy towards the end of the scheme that she would just staple blank pieces of paper behind the check request. So had anyone just flipped the page, you would have said, okay, this doesn't quite make sense, and asked about it, but it didn't quite go that far. So never pre-sign checks. I mean, it's it seems simple, but it happens, right? People work in a trusting environment. If you work with someone on a day-to-day basis, you don't think that they're going to steal. So you're like, I'm going on vacation. I know you need to pay the bill, or something comes up. I'm going to pre-sign the check. Whenever we do control reviews, or we're doing fraud forensic reviews, we'll ask, okay, well, is your blank check stock, locked up? Of course it is. We wouldn't leave that out in open. So then you ask, okay, well, where's the key maintained? Well, it's right up here on the wall, And I mean, true to God, I've gotten that answer numerous times, and it's funny because the check stock is locked up, but the key is not. So I would say lock up both. Purchasing and fixed asset controls. Related party transactions are a big risk for not-for-profit. There are numerous stories about contracts being diverted to a company that's either owned by, related to one of the executives, one of the board members. What are we doing to institute a fair bidding process? Do we really understand how are the vendors selected? Are they really truly a arm's length transaction? Are they, are we aware of those type of risks? When, fixed asset, I mean, in Legacy Foundation, there was all of this computer equipment that was purchased, right? But they couldn't locate it. When they actually, 3 years ago, I think, when the whistleblower, the article mentioned, when the whistleblower first came forward, he brought up an issue that he couldn't locate this computer equipment, and it was not followed up on. And it's, so are we asking the controls on fixed assets? When was the last time the inventory was done? When was the last time did we do a check that all of our assets were actually there?
Nidhi, can I stop you for a second?
Yeah.
Just one commentary on related party transactions and kind of the related issues that come into play. Obviously, prevention of inappropriate related party transactions and the regulation of related party transactions to make sure they're fair and appropriate is very important on multiple levels. But one aspect of it that can't be overlooked is the tax aspect, the tax exemption related aspect. As many of you know, tax-exempt organizations, C3s, C4s, C6s, are all subject to the prohibition on private inurement, which basically means an insider, someone who has an ability to exercise substantial influence over an organization, such as an officer, director, key committee members, employees, receiving more than fair market compensation for whatever is being provided to the organization, be it services, be it the sale of a product or whatever else. And if there is an instance of prohibited private earnestment, that can lead to a loss, a revocation of tax-exempt status if the IRS makes that determination in an IRS examination. And for 501c3 and C4 organizations, those types of transactions are referred to as excess benefit transactions. The IRS can assess very significant excise taxes, penalties, on the recipients of that excessive compensation, and can also assess a penalty on those who approve those transactions, such as a board of directors or a compensation committee or an executive committee at a nonprofit. So there are very important tax consequences to that, and even for non-insiders. So for people that or companies that don't have an ability to exercise substantial influence, but are just vendors or other contractors, consultants, service providers to the organization, if there is significant excessive compensation being paid or whatnot, or other significant benefits flowing to those individuals, that can lead in 501c3 organizations to a finding of impermissible private benefit, which also can lead to a loss of tax-exempt status. So there are some very significant tax risks that we can't forget about too.
Thank you. So talking about automated control, I mean, I think nowadays everything is in a system, right? And today's systems are very, very sophisticated. You have to ensure that your system has password controls. And there are guidelines as to number of times your password should be changed, the amount of time that you can have the same password, the length of passwords and things like that. I mean, my husband is in cybersecurity, and I get that lecture every night. I seem like. And we find when we do the investigations that you'll see that the password controls are not instituted properly, because a lot of times in one investigation, the accounting manager basically said that she used the same password because the organization had not implemented those IT controls. So they required their employees to actually change the password every 90 days, but you could basically use the same password. So she had been there for 10 years. She used the same password for those 10 years, so everybody knew it, And
where they do require passwords to be changed frequently, do you find just a bunch of Post-its on computers with passwords?
I think that not so much. I mean, and I think that's where also the training comes in. It's really kind of saying that don't put your passwords out there, and also don't make it so difficult where people have to put Post-its. I mean, I have websites that I go to like personally, and they're like, you can use 3 letters, 3 letters, 1 number, has to be special character. I have no freaking idea, what the hell did I use, And every single time I have to call, customer service and go, can you please reset my password? So don't make it complicated. I think that there is a balancing act to be done where you have to have adequate controls to change them every so often, make sure that there's enough of a variety whether it's, numbers and letters and so on, but not so complicated that they have to write Post-its. Determine who is the system administrator. I think the one control I would say is don't have your system administrator be someone in your accounting department. They are monitoring they are responsible for recording those transactions, so don't have your CFO be the system administrator, because essentially that means that he has complete and full access to the finance system, and all of a sudden your segregation of duties went down the toilet. So just you want it, to the extent possible, have it out in the IT department. Alert notifications. We talked about positive pay exception reports, wire notifications, etc. You want to make sure who is it the right person getting those notifications and right person getting those exception reports. Control measures, background checks. I mean, Widge, you talked about this earlier, how important it is to have background checks when you're doing a new hire. I was looking at the stats last night, and apparently a stat published by ADP and Society of HR Managers is that 21% of people lie on their resume on that state fraudulent degrees. So it's not like just overstating what they did. That was like more like 70%. But 21% of people put false degrees on their resumes. 29% show altered employment dates. You wanted to make sure that you're doing adequate level of background checks, especially for people in high-level positions, in finance positions, people who are handling money in your organization. And check references. We did one investigation where they had a policy to check references, but when nobody called them back, they still hired the guy. They said, yeah, we tried calling his references 3 times, and it was all documented in his personnel file because that's one of the first things we look at when we do an investigation. And it was all documented, but nobody ever called them back. And that's a red flag. You want to follow up on that a little bit. We talked a little bit about, mechanism for reporting and investigating fraud. Whom to contact, how to contact, and anonymous reporting. Can't say enough about this. As Rich said, hotlines are not as expensive anymore. They're I would say 10 years ago they were probably a little bit more expensive, but they're more cost effective now. In a small organization, it's very important that you have some means of anonymous reporting because everyone knows each other. And it's very hard if your reporting mechanism is going to the HR director, and that HR director is best friends with the CFO or something else. Well, people may not feel comfortable raising concerns. So having those type of issues. And do people know what to do when they receive a complaint or when an issue is raised? Legacy, perfect example. It's bad enough that a fraud has taken place in an organization. What's even worse is that, well, you were told about this issue 3 years ago and no one did anything, right? So adds insult to injury. And I think that you have to train the people who are receiving those, train your managers, because complaints can be raised to managers. So what to do when an issue is discovered? What steps should an organization take? I think that there's probably about 7 steps we'll go through. We'll go through them quickly. One is selection of an investigative team. We want to consider who is responsible for reviewing those allegations? Who is responsible? What's the investigative team's relationship with the suspect or the whistleblower? Because you don't want that investigator to be biased one way or the other. You want them to be objective. Is that person who is being asked to conduct the investigation high enough in the organization to get the cooperation, to get the documents they need, to get people to talk to them? You have to make sure that the supervisor, so if the allegation comes to, let's say, that AP manager or accounting manager embezzled a certain amount of dollars, and the CFO is the direct supervisor, you don't want the supervisor overseeing that investigation. Because in an investigation, one of the things that's going to be uncovered is, okay, if those allegations are true, and if the allegations are true, how did the fraud occur? How did the embezzlement happen? What controls were overridden or were lacking? Well, supervisors tend to get defensive, when you're talking about their area and some of the things that may not have taken place appropriately. We did one investigation where the organization actually was doing the investigation internally first, and the head of the department was responsible for overseeing the investigation, and the embezzlement occurred in his department. So when the investigator actually prepared her report, and she would, submit it for revision and things like that. The head of the department was so defensive and would just, keep pushing back on the investigator, so much so that the investigator herself became a whistleblower and basically said, well, the organization doesn't have, it doesn't want to find its problems, and it became a bigger issue than it really needed to become. So.
Yeah, I think this is an area that you need to be very careful with because it's an area where it's really easy to do more harm than good. You need to, when a complaint comes in, and you're going to find with your hotline like 90+% of them are going to be HR complaints. And those can kind of go off generally into one bucket. But when you get into more sensitive areas, a couple of things need to be determined right off the bat. First of all, and I know not to jump ahead of Mitty's slide, probably the most important thing for me is, first step, preserve the evidence. There have been more organizations that have gotten themselves into more trouble because they began to investigate something half-handed, sort of ham-handedly, and then they realized it was more serious than they thought, and by the time they had done something of actually collecting emails, instant messages, things like that, people had deleted them all. And that does not make the government happy when that happens. So the first step to sort of protecting the organization, in my opinion, is pull a backup tape. You don't even need to do anything special. Just make sure that what evidence might exist at that point in time is maintained. And then in terms of doing the investigation, is this something that you want covered under the attorney-client privilege? Because if you don't at least have the general counsel's office running it and then handling it correctly, that information that's gathered in the investigation is going to be fully discoverable. And again, what you see a lot of times is investigations gallop, and then they need a lawyer. But then all of that information is out in the public, it's discoverable. It might not be in the public domain, but there's nothing the organization can do to protect it if it doesn't want to get out. So that's one of the earlier decisions that need to be made is this an investigation that can be handled by, non-lawyer management or that channel? Does it need to be handled by a lawyer? Then another set is, does outside counsel or outside experts have to come in? And again, those are areas in which is senior management implicated? Would senior management be embarrassed by the findings of this? Would the person doing the investigation some way feel beholden to management? In those instances, you probably want to look outside, and you probably want to get counsel to maintain the privilege over that information. What lawyers do is we work hand in glove with the accountants and the forensic experts. But we go through sort of some legal gymnastics where technically we hire them as our experts, and that way their work is covered under the attorney-client privilege. So these are some of the things that you need to decide very, very quickly. And I think it is often beneficial to give counsel a call. Here's the facts. What do you think? Is this something we can do in-house? Should we have outside counsel? How should we structure this, and to just kind of work through these issues before you get going?
Completely agree. I mean, preservation of evidence is of utmost importance. I think triaging the evidence as well, placing the target of your investigation. You may want to place them on administrative leave or restrict their access to the books and records of the company while the investigation is going on. Because, I mean, we did one investigation recently where the executive actually found out that he was the target of the investigation, and he basically went to the IT department and under the guise of like, oh, my computer isn't working, asked them to reformat his hard drive. And the IT person was like, okay, and reformatted his hard drive. You have to, once an allegation comes in, is exactly what Rich said. So go ahead.
Yeah, no.
Okay.
And would you want to mention kind of the importance of a hold letter or email being sent?
Sure. Yeah. Part of preserve, not just to pull out a backup tape, but at the appropriate point in time, what you're going to want to do is send out a litigation hold memo in which you inform the custodians of the information or other people who may have relevant information that you got to hold on to it. Another really important aspect that many companies forget to do is to tell IT. And so the normal email deletion policies keep going. So the people have got their litigation hold memo and they're on it. But then, the email disappear from their box. And it's very important to get that out to IT. A lot of companies have computer systems where you can actually just flip a switch, which is ideal for us because that way nobody needs to be notified until you can figure things out, where nothing gets deleted once it's invisible to the user, but nothing is getting deleted from the system at that point in time. There are other things like email vaults and things like that that many organizations use. But again, I can't stress enough the importance of preserving the evidence. And one thing I would just add to that is preserving the evidence, and fairly quickly, if there seems to be anything to the allegation, stop the conduct in question. Probably the easiest example is from a lot of the Foreign Corrupt Practices Act I do. Let's say an allegation comes in that a sales representative in some country somewhere is paying bribes. Well, I've seen so many companies not put that sales representative on the shelf for like 9 months while they're sorting through this. The most important thing you can do from the standpoint of protecting the organization after preserving the evidence is if there's any there, put a halt to the conduct.
So once you've preserved it, you need to start gathering the evidence. And when you're gathering it, you've got to keep a few things in mind. You've got to document the chain of custody. You have to understand, keep information like how was the information obtained, when was it collected, who handled it, where and how it was transported, where it was stored and maintained. And I think Vich could attest to that, because in the event that this goes to litigation or anything else, you want to be able to testify to the integrity of the evidence. I mean, this is one of the first things. When an allegation happens, the organization is like, oh my God, I think I just found somebody's putting in fictitious vendors or anything like that. Well, let me look at their email. Let me do some searches on their computer. Worst idea, because once you start doing that, you're changing that evidence. You're changing the metadata. You've turned on someone's computer. All of a sudden, you've changed, when the files were created, when the files were last opened, all of this and all of that, which can present issues when you're involved in a litigation. So the e-discovery model. I mean, I think that 90% of the evidence that we review in an investigation is electronic, right? And everything in an organization is electronic, anywhere from IM, voicemails, laptops, emails, things like that. So I think, and it's a pretty extensive process, because now organizations are very, very complex. I mean, even a small organization has a lot of electronic information. People have PDAs. People have, smartphones, tablets, and so one, you have to look at what's the record. You have to look at what are the records that are maintained by the organization. What type of information is maintained in the normal course of business. You've got to then identify which are the custodians that you're looking to, whose information you're looking for. So then, and what information are you looking from them? Are you looking at their laptops? Are you looking at their IMs? Are you looking at their voicemails, their smartphones, their tablets? Are you wanting to gather all of that information? Chain of custody, we talked about that. Collection, who is doing the collection? It's so important in an investigation, to get someone to do the collection who knows how to do a forensic collection of evidence. So, when you're collecting evidence, it's not as simple as just like copying a hard drive. Because when you copy a hard drive, it's technical, but you're excluding the free space in the computer. And free space is, anytime you delete a document, it becomes a free space on your hard drive and things like that. In an investigation, you want a forensic image. You want everything on that computer, because you never know when you want to look through the deleted files. And it's unbelievable what type of information you'll find when you do a deleted file analysis. All of a sudden, you'll find the template for the fictitious vendor. You'll find the setup of when that individual actually set up that organization. Review, what type of review you're doing. I mean, when you're collecting this massive amount of electronic data, there's no way possibly that you can review all of it. You've got to be smart. You've got to develop keyword searches. Your investigative team has got to do keyword searches. So let's see. I think I'll just go with just making sure on production and presentation, what are you ultimately using that? We talked about the background checks in an investigation, and that's basically really just saying that make sure when you're doing the investigation, when was the last time the background check was done on a target? And are we looking at the information collected in light of the allegations? Interviews, great source of information. I think that you want to make sure that you review your evidence before you start interviewing and talking to people and letting them know what it's all about. Do you want to talk about Upjohn?
Yeah. Yeah, I mean, usually the interviews and the way an investigation takes shape, you might talk to some people preliminarily, but then what you're going to do is you're going to collect the documents, you're going to review the emails, and you're going to talk to folks. And as Nidhi mentioned, it's very important to have two people there. You always want a witness so you don't get into I didn't say that type of situation. But the other thing is to give what's called an Upjohn or a corporate Miranda warning. And this almost always comes from counsel, and it's very important for two reasons. It's very important in order to preserve the organization's attorney-client privilege over the information given in the interview. But the other reason it's important is not to create an attorney-client relationship with the employee. In other words, if somebody comes in and they're thinking, hey, I talked to a lawyer, this must be private, this must be confidential. If they have reason to believe that, you've now set up an attorney-client relationship with that person. And general counsel at an organization can fall into this trap, just like outside counsel. So it's very important, and then the result of that is you can't share that information because that employee, who may be the wrongdoer, now has an interest in the attorney-client relationship and that information. So there's a set warning that's given which basically just says, I represent the organization, not any individual in the organization. I don't represent you. Do you understand that? Now please answer my questions. I usually do it with a much lighter touch than that, but we're running out of time.
So there's two last slides, and we'll go through them pretty quickly because I think we're running way out of time. Reporting, I think the main thing to consider, work with counsel. You want to make sure, determine whether the report should be oral, written, what are the privilege issues that you need to consider. Make sure that it's factual. There's no reason, when we do investigative reports, it's facts and facts. There's no opinions in there. There's no that this person embezzled money or anything like that. It's just actual facts. And you shouldn't contain recommendations for disciplinary action.
I would even go a step further in terms of reports that I assume that anything one day is going to become discoverable for one reason or another. So I'm not a big believer in written reports. And if they do need some type of writing just to keep it as an outline on a PowerPoint, I'll go over the investigation process all day long and what we did. I'm happy to put that into writing. But then when it comes to, as Nidhi mentioned, conclusions, recommendations, just leave it out. You don't want that used against you in court one day.
And the last part is just, one thing that comes. Oh, sorry. The end result of every investigation is what is the root cause analysis? How did this happen? What internal controls weren't there? What internal controls were overridden? You have to identify what controls need to be remediated. And I think and taking those type of issues and changing your, whether it's revising your policies and procedures, revising your workflow to address those control concerns needs to take place. And that's part of the compliance program, the living and breathing component of the compliance program.
Jeff, I have a question for you in terms of investigations and with respect to the Form 990 and sort of the detailed information that's required. Does that make it incumbent upon an organization to conduct an investigation if they have a rational report of a fraud?
I'm not sure that there's anything in the Internal Revenue Code or regulations or the Form 990 or its instructions that would necessarily require that from a tax exemption perspective. The question on the 990 that kind of sparked Joe's investigation, that requires a disclosure of a significant diversion of assets and defines what that means, basically at a lesser of $250,000 or 5% of the organization's revenues or assets. Requires that disclosure be made, and then there's instructions that you're supposed to disclose other details in terms of what happened and what the result was there any reporting to authorities, things like that. So you are supposed to disclose all of those details, as Joe found out. A lot of organizations have not done that sort of disclosure, and Joe's reporting is putting a lot of spotlight on that and will, I think, cause a lot of organizations in the future to do a lot more of that disclosure. So I guess the short answer is, while it's not perhaps required, for federal tax purposes, it's certainly, an incredibly important thing to do from many, many other perspectives, including, frankly, the integrity of the nonprofit. Nonprofits are private organizations. They're not governmental entities, but they're subject to a certain public trust, and they have certain benefits as a tax-exempt organization. A lot of them as public charities, where there's a certain accountability, I think, to the public. And so when you have a sign of a significant diversion of assets or any kind of fraud or embezzlement, you have an obligation to investigate and do something about it, and of course to report it now on the 990. And the bad thing about that, of course, is that the IRS has said that when they get disclosure of a significant diversion of assets, it may well trigger an IRS examination. There's other things on the 990 disclosures that sometimes trigger IRS examinations as well. It's not a position that anyone wants to be in. We've handled a couple hundred IRS examinations in the last decade or so of exempt organizations. They're no fun for our clients, but there's really no way to avoid that.
Anybody have any questions?
Well, actually, unfortunately, we're over time. We're not going to be able to take questions. If anyone has any questions, feel free to email myself or our speakers directly. I want to thank Widge and Nidhi and Joe for a terrific job today. Thank you all for sticking around late, and we hope to see you back here next month.